Question of the week this week. You are required to get mortgage insurance on your loan until you get to a point of owing less than 80% of the value on your home. On a $450,000 house, mortgage insurance is about $350 a month. What's the best option? So if something happens, the house is paid off and not a burden for the family. Great question. We're talking about a couple different types of insurance related to mortgages here. First of all, the primary mortgage insurance is the insurance you have to carry until your balance gets to 80% of the value of the home. And so anytime you make a down payment on a new mortgage of less than 20%, you're going to have primary mortgage insurance. This insurance really doesn't benefit you. It's to protect the lender. If you stop making payments, then this insurance would make payments, some of the principal to the bank to help the bank along, but you're still on the hook for your loan payments. And if you get too far behind, then the lender can still foreclose on your home. When you get to 80% of the value of your home on the mortgage, you can request to have this insurance removed and your monthly payment will go down. This is usually a great thing, but it doesn't necessarily make sense to make extra payments in order to get that insurance to go away. We can help you calculate the return on this based on how much extra you would have to pay down your mortgage to get rid of the insurance and see if those numbers make sense. So you're welcome to give us a call. We'll be able to help you do that. The second part of the question here is, what is the best option? So if something happens, the house is paid off and not a burden for the whole family. Now we're talking mortgage life insurance. Mortgage life insurance usually comes in the form of a decreasing term life insurance policy. So the death benefit on this policy will go down over time, but your mortgage balance is also going down over time. And so they're going to match up about right and your mortgage would be paid off. The only problem with term insurance is that you don't recover any of the premiums that you pay. And so if you can afford to put a little bit extra away in premiums in a whole life insurance policy, you will recover the premiums over time. You won't have a decreasing death benefit. And when your mortgage is paid off, if you didn't need that life insurance, now you have a great asset for your family in addition to just having the protection to pay off the mortgage along the way. So if you can do that, that is the better solution most oftentimes. And we can help you see what a participating whole life insurance policy would look like if you're wanting to cover your mortgage and build a great asset at the same time. So give us a call. We can help you do that. 702-660-7000. Thank you, Kevin, for this great question of the week.